Hi everyone. In this video we'll talk about current and long-term liabilities. We've seen how assets are grouped into current and long-term categories and that long-term assets are always subclassified further. Now let's turn our attention to liabilities. These too are separated into current and long-term categories. Liabilities represent obligations to other entities. By classifying them as current liabilities and long-term liabilities, the information value of reporting these amounts is enhanced. The liability section of Nike Inc.'s balance sheets from illustration 3.7 in your textbook are shown on this slide. Nike has chosen to report the totals of each group of liability accounts as a single number on their balance sheet, but the details of the liabilities are disclosed in the footnotes to the financial statements. For instance, the footnotes would show that Nike's accrued liabilities include accrued compensation, accrued rent, accrued taxes, and accrued interest payable. Also notice that the company classifies the current portion of its long-term debt as a current liability. Current liabilities are those obligations that are expected to be satisfied through the use of current assets, usually cash, or the creation of other current liabilities. So this classification includes all liabilities that are expected to be satisfied within 1 year from the balance sheet date or within the operating cycle if that's longer than 1 year. An exception for the current liability classification is a liability that management intends to refinance on a long-term basis. For example, if management intends to refinance a 6-month note payable by substituting a 2-year note payable, and the company has the ability to do so, then the 6-month note payable would not be classified as current even though it is due within the coming year. The most common current liabilities are accounts payable, notes payable from short-term borrowings, deferred revenues, accrued liabilities, and currently maturing portion of long-term debt. Accounts payable are obligations to suppliers of merchandise or of services purchased on account. The payment is usually due in 30 to 60 days. Notes payable are written promises to pay cash at some future date. Unlike accounts payable, notes usually require the payment of explicit interest in addition to the original obligation amount. Deferred revenues, sometimes called unearned revenues, represent cash received from a customer for goods or services to be provided to that customer in the future. For example, a company records deferred revenue when it sells gift cards. Revenue is not recorded until those gift cards are redeemed by the customer for merchandise or expire without being used. Accrued liabilities represent obligations created when expenses have been incurred, but amounts owed will not be paid until a subsequent reporting period. For example, a company might owe salaries at the end of the fiscal year to be paid sometime in the following year. In this case, the company would report salaries payable as an accrued liability in the current year's balance sheet, as well as the related salaries expense in the income statement. Other common examples of accrued liabilities include interest payable, taxes payable, utilities payable, and legal fees payable. Let's do a few more bonus point scatter question words. Remember, the way this works is that I embed scatter question words over several videos. When you run across these words, write them down. When you have watched all the videos and found all of the words, you will see that they form a question. I will award 5 bonus points to the first 25 students who send me the answer to the question in a Canvas message before the due date of the Chapter 3 homework. The bonus point scatter question words for this video are you consider, Y-O-U, consider, C-O-N-S-I-D-E-R. Also recorded as a current liability are the current maturities of long-term debt. And that refers to the portion of the long-term debt that will become due within the next year or operating cycle, if longer. For example, a $1 million note payable requires $100,000 in principal payments to be made in each of the next 10 years. The amount that is due in the following year is $100,000, and that needs to be classified as current liability. The remaining $900,000 will not be paid in the next year, and therefore should be classified as a long-term liability. Long-term liabilities are obligations that are 1. Due to be settled, or 2. Have a contractual right by the borrowing company to be settled in more than 1 year, or more than the operating cycle if longer. Examples are long-term notes payable, bonds payable, pension obligations, and lease obligations. But simply classifying a liability as long-term does not provide complete information to external users of the financial statements. For instance, long-term could mean anything from 2 years to 20 years, 30, or even 40 years. Payment terms, interest rates, and other details needed to assess the impact of these obligations on future cash flows and long-term solvency must be reported in a disclosure note. Here's another easy concept check question for you. The key distinction between current liabilities and long-term liabilities is A. The amount of the obligation to be satisfied, large versus small. B. To whom the obligation is owed, those inside versus those outside the company. C. The length of time until the obligation is expected to be satisfied, less than 1 year versus more than 1 year, or operating cycle if longer. Or D. The nature of the obligation, determinable versus estimated amount. Please pause the video and think about the question and choose your answer. Then start the video again to check your work. I think you probably all got the fact that the correct answer is C. The key distinction in the time period in which the obligation will be satisfied. If it will be satisfied within 1 year or operating cycle, it should be classified as current rather than long-term. Well, that's all for this video. In the next video, we'll discuss shareholders' equity. See you next time.